Not all expenses are treated the same way. In this video, we'll explain the difference between revenue and capital expenses, as well as the difference between business and private expenses and what you can claim in your income tax return. You need to understand how expenses work because they're an important part of your tax calculation. When you complete your return, you record your gross sales for the year and deduct your business expenses. This will give you your net profit. You pay income tax on your taxable income, which will be your net profit plus any additional income. Revenue expenses are incurred in the day-to-day running of the business. They're expenses like stationery, rent, power, and your ACC levies. Revenue expenses can be deducted from your gross income, provided the expense relates to your business. Capital expenses are different. They're big-ticket items that you keep in your business for longer than a year. Common examples include motor vehicles and machinery. You can't claim a deduction for a capital expense. Instead, you claim depreciation. Moving on to private versus business expenses. Private expenses are not deductible. So if the expense is partly business and partly private, you need to make an adjustment to ensure you're only claiming the business percentage. So let's have a look at Alan's office, car and other expenses. Alan has an office based in his home. As he has set aside this office exclusively for business use, he is able to claim a percentage of his household expenses in his tax return. Common examples of household expenses are rates, insurance, power, rent, and interest on your mortgage. The percentage you can claim is based on floor area. Alan's office is 10% of the total floor area of his home, so he can claim 10% of the household expenses he uses for business. Alternatively, if unsure of the percentage, Alan could have used our square metre rates to work out the amount of household expenses he can claim. Alan's office overlooks his driveway, which has his car in it. Alan's car is for both business and private use. To claim the business expenses relating to his car, Alan can work out the percentage of business use or keep a record of total kilometres travelled for business. To work out the percentage of his car use that is for business, Alan can keep a logbook and record each business trip he makes in his logbook for 3 months. After 3 months, Alan can work out the number of kilometres he's travelled on business as a percentage of total kilometres travelled. This is the percentage of his motor vehicle expenses that he could claim in his tax return. Alan can use this percentage for 3 years. After 3 years, Alan would need to keep a logbook again for another 3-month period. Or Alan could claim the inland revenue kilometre rate. As well as his logbook, he would need to record his odometer reading on the 31st of March each year. He would then calculate his claim based on the logbook percentage, the total kilometres travelled, and the kilometre rates. Alan makes other private use adjustments for other expenses too, like his telephone expenses and entertainment. As required, he keeps a record of his expenses as he goes. Alan uses a cash book to keep track of his expenses and his income. Alan keeps all of his invoices and receipts because if he's audited and doesn't have his paperwork, his claim may be disallowed. Alan keeps his records electronically and he makes sure to keep a backup copy. Accounting software can help here. Wrapping up, to find out about your ACC levies, check out ACC's website. For useful tools and resources for business, visit business.govt.nz. Visit our website ird.govt.nz to find out more information about expenses.